Silver just crossed $95. Dark market gold in China has printed $6,000. Nearly 100 million ounces have drained out of Comex in 60 days, and the war that triggered this is nowhere near finished. The strait closed, a dark market cracked open, and a number appeared on a screen that should not exist. $6,000. While most people were sleeping, the world's most important energy choke point went silent. China's gold trading was suspended. And silver started doing something it has not done in over 50 years. The last time these exact conditions lined up, silver didn't double. It didn't triple. It went up 27 times. What comes next may change everything you thought you knew about your money, your savings, and your future. Stay with me, because what I'm about to walk you through cannot be unseen. Welcome to this Silver Alert. This is where serious people come for serious economic intelligence. If you've worked hard your whole life, built something, saved something, protected something, then this breakdown is for you. Think of it like a checkup for your finances. You wouldn't ignore your doctor at your annual exam, so don't ignore the one alert that could protect everything you've built. Now let's rewind to the moment this really began. Segment 1. The Sunday night where it all changed. It was a Sunday night. Most people were relaxing, watching TV, scrolling their phones, thinking about the week ahead. But the screens that mattered were telling a different story. Silver was sitting at 95.59 per ounce. Gold was up $86 in a single session. Futures were confirming the move. This wasn't a glitch. It wasn't a rumor. It was real money moving fast in one direction. If you had been watching precious metals for years, you'd have seen big moves before. But this night felt different. This night felt like the beginning of something much larger than a normal price swing. Because the story didn't start with silver, it started with war. Segment 2. Operation Epic Fury. 4 weeks of war in the energy heartland. In February 2026, the United States and Israel launched a coordinated strike campaign on Iran. The operation had a name, Epic Fury. Hundreds of targets were hit. Thousands of pounds of munitions were dropped. It was one of the most significant military actions in the Middle East in decades. President Trump addressed the nation in an 8-minute statement. He gave Iran a choice: negotiate or face total decimation. No middle ground, no soft diplomatic language. The message was clear, and the world held its breath. Within hours, reports came in that Britain was considering joining the conflict. Hypersonic missiles, weapons so fast they cannot be intercepted, were reported heading toward Jerusalem. The Ayatollah's compound had been hit. Communication from Iran's leadership went dark. Trump himself said the operation could last 4 weeks, not 4 days, not a quick in and out. 4 weeks of sustained military engagement in the most energy-sensitive region on the planet. One analyst, known as King Kong 988, put it in brutal terms. If this war drags on, it will cost the United States trillions of dollars. Not billions, trillions. And that raises one simple question. Where does that money come from? Segment 3. The printing press and uncertainty. The twin engines under metals. The United States is already running a massive fiscal deficit. There is no secret vault with the label Emergency War Fund sitting full of cash. That money does not exist. It has to be created. In a fiat system, there is only one place it can come from: the printing press. When a government prints money to fund a war, the currency loses value. Every new unit quietly steals purchasing power from every existing unit. That's not a theory. That's recorded history. It happened during Vietnam. It happened during Iraq. It happened during Afghanistan. Every time, gold and silver went up. But there was a second force at work that night, just as powerful as the printing press: uncertainty. When people don't know what tomorrow looks like, they do what they've done for thousands of years. They move away from paper, they move toward metal. That is not panic. That is rational behavior from serious money in a geopolitical crisis. Now you had both forces active at the same time. War-level money printing, radical uncertainty, silver at 95.59, gold surging, a war expanding, and a printing press about to switch on. It was just the beginning. But the war was only the first layer of the story, because somewhere else, something even more alarming was happening. Segment 4, the Strait of Hormuz. When the world's artery shuts, there is a narrow strip of water on this planet. At its tightest point, it's only about 21 miles wide. You could drive that distance in under 30 minutes, but if it closes, the entire global economy starts to suffocate. Its name is the Strait of Hormuz. On that Sunday night in February 2026, it was no longer open for business. Pull up the map. On one side, Iran. On the other, the Arabian Peninsula. Between them, a narrow waterway connecting the Persian Gulf to the open ocean. Flowing through that channel every single day, 20-30% of all global seaborne oil, about 20 million barrels per day, roughly 20% of the world's liquefied natural gas. This isn't a regional shipping lane, it's an artery. Block it and shockwaves hit. Rich and poor countries, east and west, developed and developing economies, and Iran had just closed it. The first signal came from Kuwait. The Kuwait Stock Exchange halted all trading until further notice. Not for maintenance, not for a glitch. It was a real-time government-level decision while missiles were still in the air. When a stock exchange shuts down like that, it means the people running it believe prices are about to move in ways the system cannot handle. They're not protecting investors. They're protecting the system. Then came the shipping news. An oil tanker named Skylight was struck in the Strait of Hormuz, the first direct attack on shipping in this conflict. One vessel, one strike. But the message was immediate. Maersk, one of the largest shipping firms in the world, announced it was suspending all shipments through Hormuz. Think about what moves on those ships: oil, gas, raw materials, factory components, food, medical supplies. Every ship that stops moving is a gap in a supply chain somewhere on Earth. This was not just a war story. It was an energy shock story. And energy shocks have form. Segment 5, the 1970s template, when silver went up 27x. To understand what an energy shock can do to metals, you have to go back to the 1970s. During the Arab oil embargo, gas stations ran dry, lines stretched for miles, governments panicked, economists scrambled, and in that chaos, silver did something extraordinary. It started below $150 per ounce. By 1980, it hit about $50. That's not a 50% move, not a double. That is about 27 times higher in a decade, largely driven by one thing: an energy shock almost nobody saw coming until it was already at their doorstep. Now fast forward, another energy choke point is compromised. A new energy shock is forming, and silver is already near 95s, not 150. But energy was only half the story that night, because inside China's gold and silver markets, something happened that had literally never been seen before. Segment 6. China's dark gold market prints $6,000. A number hit a screen in China that should not have been possible: $6,000. This wasn't clickbait, it was a price in the dark market for gold. Here's what that means. China doesn't run its gold market like the West. No loud TV debates, no flashy headlines. Serious moves usually happen quietly: internal memos, bank notices, whispered reports. This time it was loud. The key source was an analyst known as Oriental Ghost, a verified insider in China's precious metals networks. His message that Sunday night was simple and shocking. China's dark market gold, physical gold traded outside official exchanges and private networks, had touched $6,000 per ounce. At that moment, the official global spot price was around $3,200. That means the people closest to the metal, who actually need it in hand right now, were paying nearly double the world price. When a dark market diverges that far from the official price, it means one thing: the insiders do not believe the official price reflects reality anymore. That's not speculation. That's a market screaming. Then came the bank notice. Segment 7. Chinese banks hit the panic button. A major Chinese financial institution issued an emergency circular to clients. The language was formal. The tone was calm, but the message was not. Due to extreme price deviation and rapid depletion of accumulated gold liquidity, gold trading was suspended immediately. The bank warned that a massive volume of renminbi savings was sitting on the sidelines, ready to pour into gold the moment trading resumed Monday. Respected American analyst Vince Lancy made a critical observation. When a government preemptively shuts its own gold market, that is not a sign of strength. It's a signal of structural stress at the deepest level. He compared it to what happened to U.S. oil trading floors after September 11th. Markets do not close unless the people in charge believe staying open would cause more damage than closing. China made that calculation in real time during a live geopolitical crisis, and it didn't stop there. Segment 8. Empty shelves in Shenzhen and queues in Singapore. From the Shenzhen Shuibei gold market, one of China's biggest physical hubs, came another disturbing report. Jewelry manufacturers were arriving to buy gold bars. They were leaving empty-handed, not because of price, not because of paperwork, because the bars weren't there. Shops that had operated for decades, never once struggling to source inventory, now faced shelves they couldn't refill. This was no longer a future story. This was a physical shortage story, and it wasn't just China. In Singapore, bullion dealer Bullion Star released ground-level data for Friday the 27th. Silver had corrected over the prior month. Prices had pulled back, yet customers were still lining up outside the door, not leaving, not waiting for a bigger dip, not hesitating. Serious buyers understood something casual observers didn't. Corrections in a structural bull market are not warnings. They are invitations. And the people in that line understood that better than most financial advisors sitting in glass towers ever will. Now add one more piece: Comex. Segment 9. Comex. 100 million ounces gone in 60 days. Comex, the U.S. electronic futures exchange where silver trades as contracts, was bleeding. Vault data showed, January 2026, 51 million ounces of silver removed from Comex vaults. February 2026, another 48 million ounces walked out. Nearly 100 million ounces of physical silver gone in just 60 days. Analyst Ed Steer added, the silver market is entering its sixth consecutive year of structural supply deficit. That means demand has exceeded supply every single year for half a decade. This combination is not normal. Dark market gold at $6,000 in China, Chinese banks suspending gold trading, physical shortages in Shenzhen, Singaporeans lining up even on a correction. 100 million ounces drained from Comex in 60 days. 6 years of supply deficits. Any one of those data points alone would be serious. Together, they describe one thing: a market that is not running low on metal, a market that is running out. And yet, the most important part of the silver story was still underneath all of this, because what was building wasn't just a supply shock. It was three independent forces compressing together at the same moment. Segment 10, the three-layer silver thesis. There are moments in financial history when everything lines up, not one factor, not two. Three separate independent forces collide at exactly the same time. That's what's happening in silver. Call it the three-layer silver thesis. Layer 1, the monetary floor. Layer 2, the coiled spring. Layer 3, the industrial turbo engine. Let's take them one by one. Segment 11, Layer 1, the monetary floor. Most people treat silver like just another commodity, something that goes up and down with industrial cycles, something traded by specialists, a line on a Bloomberg screen. But for most of human history, silver was money, longer than gold in many civilizations. It was everyday currency, savings, generational wealth, the unit of account and trade across continents. So if silver is money, we have to ask, if the money used to price silver has been printed at an insane rate since 1971, what is silver actually worth in real terms? Analyst Michael Oliver answered that precisely on Sprott's weekly wrap-up. If you adjust silver for M2 money supply growth, accounting for how much paper has been created since silver's $50 peak in 1980, today's silver price should already be somewhere between $170 and $200 per ounce, not as a moonshot target, as a simple math correction for currency debasement. At around $95, silver is not expensive in real terms. It is deeply undervalued. That's layer 1, the monetary floor, the baseline before any other forces show up. Segment 12, Layer 2, the coiled spring. Layer 2 is the pressure that's been building for decades, for years, and this is not conspiracy, it's in court records and settlements. Major financial institutions manipulated silver prices on Comex, spoofing, wash trades, coordinated actions to cap rallies, regulators fined banks, traders went to court. The manipulation was documented and punished. Suppression was real. And suppression creates energy. Picture pushing a beach ball underwater. With enough force and weight, you can hold it there. You can even make people think that's where it belongs. But you cannot hold it there forever. The moment your grip weakens, the ball doesn't slowly rise. It explodes to the surface. That's what decades of suppression have done to silver. They turned it into a coiled spring. Every capped rally, every smash, every spoof added energy under the surface. Michael Oliver warned, don't be surprised if silver starts moving in $10, $20 jumps in a single day, not over weeks or months in one session. That's what a coiled spring looks like when it lets go. Layer 2 is not a prediction, it's a pressure calculation. Segment 13, Layer 3, the industrial turbo engine. Layer 3 is the piece that didn't exist for most of silver's history. For centuries, silver's value was almost purely monetary. Today, that world still exists. But on top of it, we've built a second world, an industrial machine that runs on silver. Right now, roughly 60-67% of all silver consumed globally goes to industry. Not investors, not central banks, not jewelry, factories, engineers, infrastructure. Silver is essential in solar panels. Every panel uses it, and there is no perfect substitute with the same performance. Embedded in artificial intelligence infrastructure, server farms, chips, switchgear, connections. Critical in electric vehicle batteries and rapidly evolving solid-state technologies that use even more silver per unit than older chemistries, needed for 5G networks, medical devices, semiconductor manufacturing, defense systems, and more. Every one of those sectors is growing, not stabilizing, growing aggressively year after year. Meanwhile, mine supply, around 815 million ounces per year, basically flat. The former CEO of Hecla Mining has said publicly, meaningful new silver production cannot realistically come online before 2030 at the earliest. On the demand side, Bank of America is standing by a $135 silver target based on supply deficits. Michael Oliver's momentum work points to $300, $500 potential. Layer 3 is not some hype factor. It's an industrial reality that doesn't switch off when geopolitics calm, rates go up or down, a news cycle moves on, it runs 24/7, consuming more silver than the ground can replace. Segment 14. When the West finally wakes up, so now you have Layer 1, monetary floor, silver undervalued versus money printing. Layer 2, coiled spring, decades of suppressed pricing and legal manipulation. Layer 3, industrial engine. A structural demand pipeline that won't stop. All three are active, at the same time, in the same decade, in the same month. And here's the craziest part. Most Western investors still have zero silver exposure. The average American has never walked into a coin shop. The average European pension fund has no silver allocation. Most generalist funds that move markets have not touched the sector. History is very clear about what happens when they finally arrive. Generalist money doesn't trickle into a forgotten sector. It floods in. And if that flood shows up in a silver market that is already in a 6-year structural deficit, already seeing 100 million ounces drained from Comex in 60 days, already facing physical shortages in China and Singapore, already watching dark market gold trade at double the official price, the math gets very uncomfortable for anyone who waited too long. Segment 15. The question you can't dodge. So here we are, war in the most sensitive energy region on Earth. The Strait of Hormuz functionally shut. Shipping companies suspending traffic. Stock exchanges in the region halting trading. Dark market gold at $6,000 in China. Chinese banks suspending gold trading because liquidity is being drained. Physical shortages in Shenzhen. Bars simply not there. Queues in Singapore. Nearly 100 million ounces gone from Comex in 2 months. 6 straight years of silver demand beating supply. Silver at $95+, with monetary, structural, and industrial arguments that say this is still cheap. The 1970s gave silver a 27x move with basically one of these forces, an energy shock and some monetary debasement. Right now, you have 3. The question isn't, will silver move? It's, will you be positioned before it does? I am not your advisor. I don't know your risk tolerance, your time horizon, or your situation. But I do know this. The people closest to the metal, in China, in Singapore, in Comex vaults, are acting like it's running out. The math backs them up. And the last time the world saw even part of this setup, the move was not 20%, not 50%, not a double. It was 27 times. Decide how you want to play it.